We have come to the last part of chapter 7. Before going into chapter 7, I just want to ask about the quarterly examination. Many of you have done it really well, but I expected a better performance from many of you. This time we had 2 marks, 3 marks and 5 marks question. You had some difficulty in scanning and converting it into PDF and posting it in the WhatsApp as well as Google Classroom. But I'm sure you would have learnt it by now, because you would have done 5 exams after the economics exam, and I trust that you would have mastered the art of scanning and converting into PDF. So from the next cycle test, you will be writing the quarterly exam 2 on October 17th. So for that test, I expect you to scan it properly, convert it into PDF. When you convert it, you have to change the file into your name and then post it in the Google Classroom. So this will be for the next quarterly exam 2. Our portions will be chapter 4, 5 and 6. We will meet through the Google Meet for the revision, and I will revise certain questions during our Google Meet. The last part of chapter 7 is foreign direct investment and trade. This is a very lengthy chapter. Hope you remember the concept that I have taught already. Before ending the video, I will brush up with all the things that we learnt in this 7th chapter, so that you will be able to recall what we have learnt. Now coming to foreign direct investment, it is found on page number 144, 7.10. Foreign direct investment, in short it is called as FDI. So FDI is an important factor in global economy. So worldwide, in the worldwide economy, foreign direct investment plays a very big role. It is an important factor. Foreign trade and the foreign direct investment are closely related. So foreign direct investment is very useful for developing countries like India, particularly in the area of natural resource sector, and in the plantation sector, it increases the trade volume. Foreign direct investment also helps us to generate income. It helps in the generation of income and employment. So first you must know what is foreign direct investment. So what do I mean by the term foreign direct investment? FDI means an investment in a foreign country that involves some degree of control and participation in management. So what is foreign direct investment? It means an investment in a foreign country. We are all living in India. We are all Indians. Okay, we live in India. In case we want to invest in some other country, we have a lot of money and we feel like investing in some other country. So a resident in India, if he invests his money in some other country other than India, it is called as foreign direct investment. FDI means an investment. A person is making an investment. Where is he making the investment? He is making it in a foreign country. He is making an investment in a foreign country. A person living in India is investing, for example, in Japan or in Maldives, or he is investing in Africa. That is called as foreign direct investment. Similarly, a Britisher who is living in UK, he is investing in Sri Lanka or India. That is also called as foreign direct investment. So a person from India can invest in some other country, Similarly, a person who is living in a foreign country can also invest in India. So he is making an investment in a foreign country, and later on it involves some degree of control. Suppose if a foreigner is starting a factory in Chennai, okay, he is having a factory in Chennai, he has invested his amount, and he has certain degree of control, and he can also participate in the management and administration of that firm. So he's not only investing, but he also has a control in the administration of that particular firm in which he has invested. Foreign direct investment means an investment in a foreign country. It's just not only investment, but it also involves some degree of control and participation. He is able to control and he is able to participate in the management of that particular firm. It corresponds to the investments made by a multinational enterprise in a foreign country. Similarly, it can be an individual who's investing. At the same time, a multinational company, a, a company like Bata or Honda or KFC, they are also investing in India. It can be an individual or it can also be a multinational company which is investing their amount in a foreign country. So hope you understood this term, foreign direct investment. So here it's an investment done by citizens and government of one country. One country means from his home country in industries of another country. The country in which he is going to invest is called as the host country. The country in which he is residing is called as home country, and the country in which that particular person is going to invest is called as the host country. So investment done by citizens and government. So it can be a citizen who is investing in a foreign country or a government which is investing in a foreign country. So investment done by citizens and government of one country in industries of another country is only called as foreign investment. And investment becomes foreign investment when so foreign investment can be through foreign direct investment or foreign institutional investors. So it can be a direct investment or it can be a institutional investor investing in some institution, a foreign institution. So an investment becomes foreign investment when it is done as foreign direct investment or foreign institutional investors. Next is foreign portfolio investment. This is FDI. Next is FPI. It means the entry of funds into a nation where foreigners deposit money in a nation's bank or make purchase in the stock and bond market sometime for speculation. So what do you mean by foreign portfolio investment? It means that there is an entry of fund. There is an entry. What do you mean by entry? Some foreign fund is entering our nation, or a foreigner is depositing his money. An American is depositing his money in our bank, maybe State Bank or Indian Bank or RBI. He is investing his money, or he also makes a purchase in stock and bond market. He is buying shares. He is buying stock and bond from the markets for speculation. What do you mean by speculation? He believes that if he invests 1 crore, he can get profit worth 5 crore. That is only called a speculation. In future, if he invests his money today, he feels that he will get more from it. That is only called as speculation. எதிர்பார்க்கிறது. இன்னைக்கு நான் போடுறது நாளைக்கு எனக்கு நிறைய காசு வருமா, அதுக்கு பேர் தான் என்னது, ஸ்பெகுலேஷன். ஸோ ஹியர் the funds are entering our nation. Okay, a foreigner is depositing his money in some Indian bank, or he can also purchase a stock or a bond for speculation reason. That is called as foreign portfolio investment, FPI. Last one, foreign institutional investment, FII. It is an investment in insurance companies, pension funds, and mutual funds. So here a foreigner is investing in our companies. It may be insurance company or pension fund or mutual funds. So in commerce you would have studied about mutual fund. So what is a mutual fund? A mutual fund is a company that pools money from many investors and invests the income in securities such as stocks and bonds. So a mutual fund is a company. Suppose if I have money, you have money, and our classmates 10 or 15 girls have money, they do not know where to invest. They can invest in the mutual fund. The mutual fund in turn will pool in, they will collect all the money, and now the sum of money will be large. Each individual would have contributed a little amount, but after pooling all the amount, when it becomes a large amount, they invest it somewhere to buy a stock or a security or a bond, and that profit will be divided among the people who have invested in the mutual funds. So what is a mutual fund? A mutual fund is a company. It pools money from many investors and invests the money in securities such as stocks and bonds. So foreigners can also invest their money through mutual funds. So foreign institutional investment is nothing but it is an investment in the insurance companies or pension funds and mutual funds. So FFI is a common term in the financial sector of India. So we learned what is FDI, what is FPI, and what is FII. So what are the objectives of FDI? That is question number 34. What are the objectives of FDI? There are 4 objectives. First one, it is for sales expansion. The sale is expanded, or the sale of good is expanded. Suppose, for example, I want to explain this with Kanjipuram silk sarees. Kanjipuram silk sarees is famous in Chennai or in Kanjipuram, that is found in South India. Here they are able to sell 1,000 sarees. Suppose if the same thing, okay, is invested abroad, if Kanjipuram silk saree opens the showroom there, if they invest their money there, instead of selling 1,000 sarees in India, now they are able to sell another 1,000 sarees in some other country. So sales is expanded. There is expansion of sales. There is acquisition of resources. What do you mean by that? Suppose, for example, KFC chicken. KFC chicken, they have got branches in India. It is not an Indian company. It is an American company. It has got branches in India. Okay, for KFC chicken, what is the raw material needed? It needs chicken, spices, water, oil. They require a land to have their factory or firm or outlets. So all these resources are Indian resources. Okay, the company is a foreign company, but all the resources, the meat, the oil, the land, all that belongs to India. So what happens? Americans are investing in our soil, but the profit, they are making the profit. At the same time, they give a share of their profit to our government also. So they are making use of our resources. So they are acquiring our resources, natural resources or man-made resources. So FDI has the following objectives. 1, for sales expansion. 2, for acquisition of resources. 3, diversification. So they are able to have their outlets in all the countries. It's just like expansion of sales, diversification. Then minimization of competitive risk. The competition within the country reduces when more outlets of foreign goods are also seen in India. So these are the objectives of FDI. 1. Sales expansion. 2. Acquisition of resources. 3. Diversification. And 4. Minimization of competitive risk. The risk involved in this competitive risk is minimal. It minimizes the competitive risks involved. So what are the advantages of FDI? 7.10.3. What are the objectives? There are many objectives. I would like to explain a few. FDI helps to increase the investment level and thereby the income and employment in the host country. So it increases the investment, it increases the income, it gives employment to more people in the host country. If KFC has opened a branch in India, who gets employment there? Indians only. Indians only work in that outlet. So it gives employment opportunity to Indians. At the same time, they get income. So it helps the host country. So FDI helps the host country by increasing the investment level and thereby the income and employment. Then direct foreign investment may facilitate transfer of technology. We are able to learn the technology of Americans or Hyundai, Honda company, Suzuki Motors. We are able to learn the technology of Koreans, the Japanese. So there is a transfer of technology to the host country. So first one I said it increases the income and employment in the host country. Second one, there is a transfer of technology to the host country. Then it also brings revenue to the government of the host country, because if foreigners have their firms or industries in India, they have to pay taxes or they have to give a part of the profit to the Indian government. So FDI may also bring revenue to the government of the host country when it taxes profits of foreign firms or gets royalties from concession agreements. Fourth one, a part of profit from direct foreign investment may be plowed back into the expansion, modernization, or development of related industries. So the profit earned by that particular firm in India can be used to create more firms. So a part of the profit from direct foreign investment may be plowed back. It can be given back to the host country, and there may be expansion of trade, there may be modernization in the host country or a development in the host country. Foreign capital may enable the country to increase its exports and reduce import requirements. So foreign capital also enables the host country to increase the exports and decrease the imports. So these are some of the advantages of FDI. So we saw the advantages. Next, let us see the disadvantages. What are the disadvantages? Private foreign capital tends to flow to the high profit area rather than to the priority sector. What do you mean by priority sector? இந்தியாவிலேயே அத்தியாவசியமான தொழில்கள் நிறைய இருக்கு. ஆனால் ஃபாரின் இன்வெஸ்ட்மெண்ட் பண்ணும்போது ப்ராஃபிட் ஓரியன்டாக இருக்கிறதுனால ப்ரையாரிட்டி செக்டாருக்கு முக்கியத்துவம் கொடுக்கறது இல்லை. ஸோ இன்வெஸ்ட்மெண்ட் பண்ணுறவங்க லாபகரமாக இருக்க தொழிலில் மட்டும்தான் இன்வெஸ்ட் பண்ணுவாங்களே தவிர, ப்ரையாரிட்டினா என்னது, முக்கியமான அடிப்படையாக இருக்கக்கூடிய தொழிலில் இன்வெஸ்ட்மெண்ட் பண்ணுறது ரொம்ப கம்மி. ஸோ private foreign capital tends to flow to the high profit areas. They tend to invest in areas where the profit is high rather than investing in the priority sectors. The technologies brought in by the foreign investors may not be appropriate to the consumption needs, size of the domestic market, and resource availability, stage of development of the economy, etc. What do I mean by that? Foreign technology, when it is transferred to India, for example, Japanese or Koreans or Germans, when they transfer that technology to India, certain technology will not be suitable for Indians. It is not suitable for us. Maybe for Westerners it is suitable. For Indian climate, our consumption, it may not be suitable. So sometimes it is a disadvantage. For example, you take pizza and burger, a simple thing. Pizza and burger is not for the lifestyle of Indians. It is for the Westerners. Like that Pepsi, Coke, they drink a lot, okay? And accordingly, they exercise. They take raw vegetables and they balance it. Whereas when it came to India, our people started eating only pizzas and burgers, which is very hazardous for the health. So certain technologies and certain consumption things are not useful for our culture. So the technologies brought in by the foreign investors may not be appropriate to the consumption needs and size of the domestic market. Foreign investments sometimes have unfavorable effect on the balance of payment of the country because they drain the foreign exchange. So foreign investment sometimes may also have unfavorable effect on the balance of payment. Initially, in the advantages we saw that it improves the exports and reduces the imports. Sometimes it may be vice versa also. So foreign investments sometimes have unfavorable effects. So these are the disadvantages of foreign direct investment. So what about foreign direct investment in India? So the early 1991 witnessed reforms in the economic policy. That is the time when we had the LPG, liberalization, privatization, globalization. We have already seen about that in Standard 11. So from 1991, there was an increase in FDI in India. So in areas, the major sector benefited from FDI in India or financial sector was benefited, insurance was benefited, telecommunication, hospitality and tourism, pharmaceuticals and software and information technology. So these are the major sectors benefited from FDI in India. So, what are the major sectors benefited from FDI in India? They are the financial sector. Financial means what? Banking as well as non-banking sector, insurance sector, telecommunication, mobiles. Okay, all these telecommunication, hospitality and tourism, pharmaceutical, then information technology. These are the major sectors which was benefited by FDI. And FDI is also not permitted in certain areas. It is not permitted in arms and ammunitions, that is wars, weapons which are used for war. FDI is not permitted in that area. It is not permitted in atomic energy, railways, coal and lignite, and mining of iron, manganese, chrome, gypsums. So FDI is not permitted in certain areas. The areas in which FDI is not permitted is arms and ammunitions, atomic energy, railways, coal and lignite. All this you please make a note of it in your textbook. Maybe it will be asked as a 2 marks question or a creative question because you do not have book back questions on these side headings, FDI in India. So it may be asked as a creative question. நான் சொல்றது விளங்குதா? புக் பேக்ல இதுக்குரிய கேள்விகள்லாம் நிறைய இல்லை. அப்போ கிரியேட்டிவா உள்ள இருந்து கேட்கறது இந்த கொஸ்டின்ஸ்லாம் கேட்கலாம். The major sectors benefited from FDI in India. What are the major sectors benefited from FDI in India? அந்த கேள்வி கேட்கலாம். FDI not permitted in the industrial sectors. எந்தெந்த செக்டார்ஸ்ல FDI is not allowed. இந்த கொஸ்டின்ஸ்லாம் என்ன பண்ணலாம், புக்குக்குள்ள இருந்து கேட்கக்கூடிய கேள்விகளா இருக்கலாம். So with this, 7th chapter is over. So what did we see in this chapter right from the beginning? First we saw the meaning of international trade. Then we saw the subject matter of international trade, pure theory of trade, policy issues, international cartels and international financial and trade regulatory institution. Then we saw about trade. What is trade? So trade is one of the powerful forces of economic integration. So trade in எடுத்துக்கிட்டா ரெண்டு டைப் ஆஃப் ட்ரேட் பார்த்தோம். internal trade and international trade. ஒரு நாட்டுக்குள்ளேயே ட்ரேட் நடந்ததுன்னா அதுக்கு பேர் internal. நாடு விட்டு நம்ம எல்லையை விட்டு வெளியில நடந்தா that is called as international trade. Then we saw the differences between internal trade and international trade. This is a very, very important question. Then we saw theories. Okay, classical theory and modern theories. Under classical theories, we saw two theories: Adam Smith theory of absolute cost advantage and Ricardo's theory of comparative cost advantage. After that, we saw one modern theory of international trade, the Heckscher and the Olin theorem. All these three trade theories are very, very important. Then we saw the comparison of the classical theory and the modern theory. Later on, we saw the gains from international trade. This is also very, very important question. After that, we saw the terms of trade. So what do you mean by terms of trade? And the types of terms of trade given by Gerald M. Mayer. Under that, we saw the different types: net barter terms of trade given by Taussig, gross barter terms of trade given by Taussig, and income terms of trade given by G.S. Dorrance. Again, we saw terms of trade related to a ratio or exchange between commodities. Then we saw terms of trade. This is terms of trade related to ratio. This is what I mentioned here. Okay, terms of trade related to ratio. Then we saw terms of trade related to interchange between productive resources. We saw the single factorial terms of trade given by Weiner and the double factorial terms of trade given by Weiner. Then we saw the balance of trade. What do you mean by favorable balance of trade, unfavorable balance of trade? Then we saw the balance of payment and the components of balance of payment: current account, capital account, and official reserve assets account. Then we saw the disequilibrium. What are the types of disequilibrium, the causes of disequilibrium, and the measures to correct disequilibrium. Then we saw foreign exchange, meaning of foreign exchange. In short, it is called as forex. There we saw the rate of exchange, the equilibrium exchange rate. Then this is again a very important question: the demand and supply. Here there is a mistake. This is only called as the demand curve and this is called as the supply curve. Demand curve always slopes downwards from the left to the right. Supply curve slopes upwards from the left to the right. Then today we saw the foreign direct investments. In that we saw what is meant by FDI, FPI, FII. Then the areas which are benefited by FDI and the areas in which FDI is not permitted, the advantages of FDI and the disadvantages of FDI. Girls, it may be a very difficult chapter. When you listen to the video the first time, you will not be able to understand anything. So I request you to listen to the video again and again. This is an advantage for you girls. Even in classroom, I will be going through this chapter only once. But here you have an advantage. Everything is recorded. It is given as videos. So you can go through these videos any number of times. So you can have your textbooks also open. You must always have your textbooks open. Only if your textbooks are open, you will be able to follow what I am teaching. Because I don't have everything as PowerPoint presentation. I've taken the important things and I've posted it. So when you follow it with your textbook, it will be easy for you. Then afterwards, every day, please learn the daily lessons, write it and see. If you just go through it, it will not stay in memory. So I request you to write it at least 2 or 3 times. Please write it and you can correct it yourself, girls. Please do it, okay?